Hey everybody, what's up? Thursday, October 5th, tomorrow, we get the widely awaited U.S. jobs report for September. That comes out at 8:30 Eastern Time, New York time. As always, I put together my forecast. I sent it out to MMT Trader subscribers if you would like to get that forecast. And you know, that number is very often a market moving number. So if you'd like to get that forecast, please go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader, or sign up for a 30-day free trial of Zombie Trading. Zombie Trading, of course, is my daily Forex signal service. It takes advantage of zombie behavior. We know how they're going to behave based on economic data releases. So we front run the zombies and we take their money and get out before they die. Both of those services are available on my website at pitbulleconomics.com. If you sign up, I'll send you the forecast. Now, my forecasts have a very high degree of accuracy. Most importantly, I have been very, very correct in predicting the magnitude over or under the consensus. You have the consensus forecast, what most economists think. What the markets react to is the deviation from that number. In other words, does it come in much higher? Does it come in much lower? Large variance from that number is what triggers the big market reaction, and that's why you got to know that. And my method of analysis, the way I go about analyzing and coming up with a forecast, is far different than the way most economists do it, and it is far more accurate. So if you want that, just go to my website, pitbulleconomics.com, sign up for a 30-day free trial of either MMT Trader or Zombie Trading. I've been talking a lot recently about the bond market and bond yields, only because this has been my primary theme since December 2015. Of course, December 2015 was when the Fed reversed course on monetary policy and started raising interest rates. Pretty much everything hinged off of that, okay? All markets hinged off of that. But the primary theme was the very fact that the central bank, the Fed, was going to be raising interest rates. So I said, that's a slam dunk trade, because you have the monopolist, the central bank, the price setter saying, hey, we're putting prices up, we're raising interest rates. You don't buy bonds in that environment. I mean, you sell. You establish a short position and you just sit there with that short position until the day comes when the Fed says, that's it, we're done. We're going to go the other way, or we're going to stop. And every single correction within that rise in interest rates, in other words, every time rates pull back, you short more bonds, or you buy more of the inverse treasury ETFs, which I had my people do. And that's paying off big time. And there will be corrections along the way. Look, it took a long time, remember, for rates to rise above 3%, for the 10-year yield to rise above 3%. We had that whole thing going on. I've been talking about this a lot. Everybody calling the top at 3%, and it's not breaking the line. And I said, it's going to break the line. Don't worry. The line doesn't control the Fed. The Fed's going to keep doing it. And the interesting thing, or the thing you need to understand, and I've said it many times, is that rate hikes generate more rate hikes. Why? Because they're price increases. They equate to fiscal expansions, right? The government is a net payer of interest. Every time it raises rates, it necessitates the government paying more interest. And then what happens? You get more inflation, prices increase, the Fed sees that, you get more economic activity. Why do you think the stock market went to all-time new highs, even though we had 8 rate hikes now? It's a stimulus. It's a stimulus. All right? So, and why do you think inflation picked up? I mean, I've been over this a million times too. You can go back and look at any chart of inflation, the CPI, the core CPI, the PCE, all right? The PCE price index, it all bottomed in December 2015. You could look at gold, all bottomed in December 2015, been going higher. And then when they see that, they raise the interest rate some more, and then they're actually, in effect, setting prices higher. They are reinforcing that inflation force by their own doing, by their own actions. And they don't understand it. And they keep doing it. So that is in play. This is not a hard call to make. Not for me anyway. What is hard is to stay in the position. I mean, it's hard for some people. It wasn't hard for me to stay in the position. But I know a lot of people struggle with these long-term macro trades because, they want action. They want action. They want it to happen right now. Like, I want it now. I want that big money now. Part of the game or the quest, if you're after the big money, the big payday on a big macro move, it's having that self-discipline, that ability to stick with it. When it looks so enticing, I just want to take that profit. It's sitting there. I want to take that profit. I had a lot of people who were with me and they're like, I want big profits. But yet every time they had a small profit, they would take it. And that would reinforce this a very short-term gratification, right? Oh, I made a profit. I'm a good trader. I made a profit. And then what happens? They see the move continue. And then they're like, damn, why did I take that profit? I should have stayed in it. So the next time what happens? They stay in it and they see the profit grow. They see the profit grow. And then it turns around and the profit disappears. And they get frustrated and they get disappointed and they beat themselves up like, why didn't I take that profit? But by staying in it, that's the right thing to do. Yes, you have to ride through a period that might be difficult and uncomfortable, but they start beating themselves up. So they reinforce this pattern of negative behavior. So the next time when they have that small profit, they take it because they remember, well, the last time when I didn't take the profit, what happened? It turned around and I should have taken that profit. So the next time they take that little profit and then what happens? They see it keeps going and going and going. And then they're like, I did it again. I did it again. And so the next time they get in there and they say, this time I'm going to stick with it. I'm not going to take that profit. I'm going to let my profit run. And they stick with it. And what happens? Ultimately, it turns back against them. And they see their profit go all the way back down to zero, maybe turn negative. And they jump out, maybe with a loss, and they say, oh, why did I do that again? And you see this is a repeating behavior. The thing to do is to have the self-discipline to ride it out and to understand what you are dealing with here. You're dealing with, in the short term, and when I say short term, it could be many months, all right? Markets that fluctuate back and forth purely on emotion and mass psychology, crowd behavior. It's noise, basically. It has nothing to do with the underlying fundamentals. Look, the underlying fundamentals, which I described and which I pointed to, okay? Back in 2015, in December 2015, those underlying fundamentals are still there. And they have been actually augmented over the last 2 years by a very, very significant amount of fiscal stimulus since Trump became president. All right, we saw, and I talked about the record amount of government spending in the just concluded fiscal year. So those fundamentals remain in place. They have not changed. And I've said this many times, these kind of fundamentals, these big macro policy-driven fundamentals, at the very minimum, they're going to last 2 years because 2 years is every 2 years is a congressional election cycle. We're going to have one coming up in early November, and that might change everything. Okay, we'll have to see what the outcome is. But At the very minimum, they last 2 years. More likely, they last 4 years. That's a presidential cycle. They could last 8 years. That's a full 2-term presidential cycle. So, I mean, nothing has changed. So, yeah, you're sitting there in a position. You have to understand that within that time frame, the market could come back on you. You could give back those gains. But over time, with those policies in effect and those conditions in effect, you're going to reap that massive reward. But it's a question of surfing that wave. Can you stay on that wave the whole entire time? And it's not the wave that knocks you off. You fall off. You jump off. So that's the key thing, and that is just mental training. You know, there's no system that's going to keep you in that thing, riding that move. And you are going to be many times enticed or fooled into thinking you got to get out. And every time you do that, that reinforces the kind of behavior that you're trying to avoid. And so many of you are trying to avoid. I want that big profit. I want that big score. If only I had stayed in it. You try it every time. You didn't have the mental strength, the mental toughness, the self-discipline to stay in. You watch these squiggles in the market, this noise knocked you off. You got scared. You got afraid. You got frightened. You jumped out. You stopped yourself out. Or you jumped out with a small profit saying, whoo, oh, I'm so happy. I got out with a profit. Whoo. And then the next thing you know, 6 months, a year down the road, 18 months down the road, whatever, 2 years, it would have been massively, massively. You could have retired on that. Bought yourself a mansion and a yacht. All right? The only other way to achieve huge gains is to go in to plunge big time with massive positions, looking for a short-term move where you are so loaded up and over-leveraged, and that is basically gambling. That's gambling. That's crapshooting. A lot of people do that. Why? That's also lack of mental game. They're looking for action. They're looking for excitement. They like that, being in that situation of extreme risk where the payoff could be huge, but in the next minute or two, you could be blown out. That's adrenaline. Those are adrenaline junkies, all right? Those are the kind of people who go after a thing like that. I prefer to look at the big landscape, take a position, and hold on to it. For most people, that's a really, really, really hard thing to do. But those are the only two ways to make big money and consistent money. The other way is you're jumping in and out, and eventually you get eaten up. You either get eaten up with commissions, or you get eaten up with, small wins, losses, wins, losses, wins, losses. You're spinning your wheels. At best, most likely you're losing money. That's how it goes. That's how it goes. But it's all in the mind. All right, pitbulleconomics.com. If you want the forecast, sign up for a 30-day free trial of MMT Trader or Zombie Trading. See everybody tomorrow. Bye-bye.